What if I told you that one of the biggest corporate implosions in recent history was hiding inside the most boring business imaginable? A company that makes everyday car parts. And that the financial engineering they used was simple enough on the surface to mislead Wall Street's smartest investors, top-tier auditors, and credit rating agencies for years. This isn't your typical business failure story. First Brands wasn't losing customers or making defective products. They manufactured reliable parts like windshield wipers and fuel pumps, components that kept millions of vehicles running. Their factories were operational, their supply chains were intact, and their market position was solid. So what went wrong? How does a company with steady demand and quality products suddenly file for bankruptcy with billions in liabilities? The answer lies in a financial engineering scheme so complex and so audacious that it confused investors, lenders, and even auditors for years. We'll break down exactly how they pulled it off, why sophisticated Wall Street firms missed the warning signs, and what this means for the broader financial system. To understand how First Brands collapsed, you need to understand what they actually did. The automotive aftermarket is a massive industry built on one simple fact: cars break down, and when they do, someone needs to supply the replacements. Unlike original equipment manufacturers who supply parts for new vehicles, aftermarket companies like First Brands focus on the replacement market. It's a good business. The average American car is now over 12 years old, so there are millions of vehicles constantly needing new spark plugs, fuel pumps, brake pads, and windshield wipers. First Brands was a major supplier in this space, distributing parts to retailers like AutoZone and O'Reilly Auto Parts, as well as directly to repair shops and service centers. It was a solid business model with predictable demand and established customer relationships. But First Brands didn't grow organically by gradually expanding their manufacturing capacity or slowly building market share. Instead, they pursued aggressive growth by buying up smaller competitors and other related businesses at a rapid pace. This kind of growth requires enormous amounts of capital, and First Brands funded it primarily through debt. That's not unusual in itself. Many successful companies use leveraged buyouts and debt to finance their expansion. What made First Brands different was the amount and complexity of their financing arrangements. The company had developed an intricate web of funding sources that went far beyond traditional bank loans. They relied heavily on what's called off-balance sheet financing. That is, financial obligations that don't appear as debt on standard financial statements, but are still real financial commitments. Importantly, this was not a private equity-sponsored issuer. First Brands was founder-owned, using a mix of syndicated loans and non-bank working capital financiers. The main tools they used for this were invoice factoring and supply chain finance, and understanding what these are is crucial to grasping how the entire scheme eventually unraveled. Invoice factoring works like this. When First Brands sold $1 million worth of parts to a major retailer, they'd receive an invoice promising payment in 60 or 90 days. But instead of waiting for that payment, they could sell the invoice to a third-party lender for some immediate cash, maybe $900,000 or $950,000, depending on the terms. This gave them instant liquidity, but at a cost. They were essentially borrowing against future revenue, and the more they relied on factoring, the more they needed to keep growing to support cash flow. Supply chain finance, also known as reverse factoring, worked differently but served a similar purpose. In these arrangements, a financial institution would pay First Brands suppliers early, and First Brands would repay them back later on, often with extended payment terms. The problem with both of these financing methods is that they don't look like debt on a company's balance sheet. To outside observers like investors, rating agencies, and even auditors, the company's books could look much better than they actually were. First Brands had what appeared to be a stable credit profile. In July 2025, S&P Global Ratings affirmed their B+ credit rating, which is solidly in junk bond territory, but still stable enough. What S&P didn't realize was that by the end of 2024, First Brand's factoring facilities totaled roughly $2.3 billion, and supply chain finance was about $680 million, rising to around $800 million by the filing. Alongside that sat about $6.1 billion in traditional on-balance sheet loans, and another $2.3 billion in off-balance sheet inventory/lease financing through associated entities. This represented billions in obligations the market hadn't fully appreciated yet. And for a while, lenders were willing to lend more. The company had recognizable brands, steady reported cash flow from operations, and what appeared to be a good balance sheet. But beneath the surface, cracks were already forming. The first public signs of trouble appeared in July 2025, when First Brands announced plans to refinance their capital structure. The goal was to extend debt payments, pushing one of their major repayment obligations from 2025 to March 2027. While refinancing is common in corporate finance, this deal raised eyebrows at S&P Global Ratings. The refinancing would actually increase First Brand's overall use of borrowed money while still lacking any meaningful financial guardrails. Just weeks after giving them a B+ rating, S&P grew concerned with the company's increasing debt burden and decreasing financial flexibility. Also concerning was the standard of their financial covenants, contractual restrictions that would limit more borrowing or require the company to keep certain financial levels. In August 2025, a covenant review by Octus's America's Covenants team scored the package at 2.75 out of 5. Without robust guardrails, First Brands had freedom to continue increasing their debt load as long as lenders remained willing. Then, on September 1, 2025, things escalated quickly. Major financial institutions expressed concerns and withdrew from planned loans with First Brands, citing off-balance sheet financing risks, basically admitting they weren't comfortable with how difficult it was to see First Brands' financial structure clearly. When sophisticated investors walk away from large deals, it's a sign of deeper problems. The market reaction was swift and brutal. By September 19th, First Brands' debt began trading at distressed levels. Senior loans that were previously traded at high prices crashed significantly. Unsecured debt fell even further. In debt markets, this kind of collapse signals that investors expect massive losses. They're only willing to pay pennies because they don't believe they'll get their full investment back. S&P Global Ratings responded on September 22nd with a dramatic downgrade, dropping First Brands from B+ to CCC+, a rating that shows substantial risk of default. They cited weak cash flows, depressed trading levels, and the company's engagement of Weil Gotshal and Manges and Lazard, classic restructuring advisors. Just 2 days later, on September 24th, S&P downgraded First Brands again, this time to CC, just one notch above actual default. They said they expected a default any day now, mostly due to the company becoming ever more short on cash. The final domino fell on September 24th when Carnaby Capital Holdings and other SPV entities with financial ties to First Brands filed for Chapter 11, with liabilities ranging from $1 billion to $10 billion across those silos. Then came September 28th, the day everything collapsed completely. The combination of masked obligations, failed refinancing, and sophisticated investors fleeing the deal created a perfect storm of lost confidence. First Brands Group filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the Southern District of Texas. The bankruptcy filings showed about $9.3 billion in recorded debt obligations and roughly $2.3 billion in unpaid factoring balances that the market knew little to nothing about, hence the widely cited missing receivables figure. S&P Global Ratings immediately downgraded First Brands to a D rating, indicating default, marking the official end of what had once been a major player in the automotive aftermarket. So far, this just looks like a company who made some bad decisions, and it all went wrong. But it was much more than that. The real shock came during the bankruptcy investigation. As court-appointed administrators began looking at First Brand's books, they identified about $2.3 billion in factored receivables that had been collected but not turned over to certain factors. Money that was expected to flow to the financiers but hadn't. This wasn't a small accounting error or a temporary cash flow problem. This was billions of dollars in expected customer payments that couldn't be accounted for. A leading theory, now under investigation by the US Justice Department and others, is multiple pledging. Here's how this allegedly worked. First Brands would sell parts to a major retailer like Walmart and receive an invoice for, say, $1 million. They would then take that invoice to a factoring company, let's call it Lender A, and sell it for $900,000 in immediate cash. Then, the allegation is that First Brands took that same invoice to a second lender, Lender B, and pledged it again for another $900,000. Now, they've received $1.8 million in cash, but both lenders think they have exclusive rights to collect that $1 million payment from Walmart. If proven, this is systematic financial misconduct. If this were happening across First Brand's entire factoring program, touching parties disclosed in filings such as Jeffries as agent/arranger and Katsumi Servicing, with other parties referenced under seal, it could explain how massive obligations were obscured for so long. But these allegations remain under investigation. Questions have been raised about auditor oversight in this collapse. First Brands was audited by BDO, which gave clean opinions months before the collapse. The question is, how does a $2.3 billion discrepancy get past a professional audit? BDO's chief executive has responded publicly that no one has accused the firm of wrongdoing in connection with its role as auditor and that it will contest false claims. Interestingly, not all major financial institutions were caught off guard. JP Morgan Chase had avoided First Brands. This wasn't luck. It likely reflected enhanced diligence following JP Morgan's $170 million loss from another auto sector financing collapse, Tricolor Holdings, which also involved allegations of double pledging. Once bitten, twice shy. CEO Jamie Dimon had warned earlier in 2025 that when you see one cockroach, there's probably more, pointing to hidden risks in the system. Despite the bankruptcy filing, First Brands didn't simply shut down. Companies in Chapter 11 can continue running if they secure debtor in possession or DIP financing. In early October 2025, First Brands announced it had secured $1.1 billion in DIP financing from a group of crossholders, essentially some of their existing creditors who agreed to provide emergency funding. The court approved immediate access to about $500 million of this money to keep the factories running, employees paid, and customers served while the company tries to restructure. But DIP financing comes with one big warning. These new lenders receive super priority status, meaning they get paid back before anyone else. It's an incentive to encourage emergency lending, but it means the original lenders, who already face large losses, now have even less chance of recovery. Importantly, First Brands' international operations were excluded from the Chapter 11 filing and continued running normally. This suggests that the problems were concentrated in the US operations, though the global implications are still developing. The fallout from First Brands' collapse extends far beyond a single company. First, the case highlights the dangers of aggressive off-balance sheet financing. While tools like invoice factoring and supply chain finance serve legitimate business purposes, they can also mask leverage and create illusions of good financial health. Second, the potential multiple pledging scandal has raised alarms. The technology and processes designed to prevent the same invoice from being financed more than once clearly broke down somewhere, suggesting weaknesses in the invoice finance ecosystem. Third, the collapse has highlighted blind spots in non-bank working capital and asset-backed financing, and parts of private credit where disclosure is lighter than in regulated bank markets. The quick growth of these markets, now in the multi-trillion-dollar range, makes those oversight gaps a major worry. Finally, the timing of the First Brand's collapse, coming alongside similar failures like Tricolor Holdings, suggests that there may be deeper problems. Both companies collapsed under similar allegations of multiple pledging collateral, raising questions about whether these are isolated incidents or symptoms of more widespread issues. The Justice Department's investigation into First Brands is still ongoing, as of this video being uploaded. No criminal charges have been filed. If systematic fraud is proven, it could lead to charges and changes in how off-balance sheet financing is monitored and disclosed. But even before the investigation concluded, SPV lenders were filing adversary complaints, and the court issued a temporary restraining order limiting the founders' access to assets. First Brand's case is a stark reminder that financial statements don't always tell the complete story, and how important it is for finances to be transparent. They were a company with solid products, an established market position, and ongoing customer demand that collapsed not because of operational failures, but because they put short-term cash solutions ahead of long-term sustainability. If this deep dive into corporate finance and alleged misconduct has been valuable to you, you might find this one interesting. Thank you for watching.